diversified active portfolio presentation. So we recommend DTC launch a retail institutional large cap portfolio product. We target moderate risk and moderate high returns of 9% to 12% over the total holding period. The targeted investor segments are institutional and retail clients, totaling in the 2.5 billion AUM, and with the split, or they both split it up in 1.25 equally. Within the next 7 years, and our fee structure will generate a total annual gross fee revenue of 37.5 million. So here's our presentation outline, our sector allocation and major holdings. We have our target market, portfolio performance, our technical analysis, and recommendation. So here is our market sector allocation. We have wholesale trades, equivalent about 13%. Information about 15%, finance and insurance 23%, transportation and warehouse 11%, manufacturing 4%, and retail trade and services at 34%.
All right, so our largest holdings are Starbucks at 26.8%, Berkshire Hathaway at 18.8%, Alphabet or Google at 14.7%, AMD at 13.2%, and Cisco at 10.4%. Our target market, we're doing 50-50 split on institutional and retail investors. Our desired holding periods are 5+ years for retail and 10+ for institutional. Our targeted investors are desiring stable long-term returns. So your retirement accounts, 401ks, IRAs, ETFs, etc. And obviously we want accredited and qualified investors, so people with high net worths of 10 to 50 million. And our target assets under management will be 2.5 billion per portfolio within 5 years. And right now we're charging about 1.5%, but after we get our fundamental and technicals trading going, we're going to bump that up to 200 basis points per in fees. And then when we implement long and short and then do derivatives, we're going to do dynamic active trading, and that's going to be about 400 basis points in fees.
Can you repeat that? I don't think anybody was listening.
Okay.
Could you listen to this, please? This is one of the key takeaways from this exercise.
When we get fundamental and technical going, we can bump up to 200 basis points in fees. And then when we implement long and short and derivative trades, we're going to be doing dynamic active trading, and we can charge about 400 basis points on that. And this is our portfolio performance. We're expecting about 9.5 to 12% over the holding period. Over the past 10 years, we had 453 basis points for our alpha, which is pretty decent.
So this is our fee structure with assets under management of $2.5 billion, which will give us revenue of $37.5 million at our current fee structure of 1.5%. As Jerry said, we are going to be bumping it up to our target fee of about 4% or 400 basis points. And our recommendation, we recommend that DTC launch a retail institutional large cap portfolio product. We target moderate risk and moderate high rate returns, or moderate high returns of 9% to 12% over the total holding period. Targeted investor segments are institutional, 1.25 billion, and retail clients, also 1.25 billion, totaling a $2.5 billion assets under management portfolio within the next 7 years. With our fee structure, we will generate total annual gross fee revenue of $37.5 million. And this is our team: Michael Beachley, portfolio manager; myself, senior fundamental securities analyst; and Jerry Reyes. He is the senior associate equity analyst.
Where you guys gonna go? Yeah, okay. Yeah, that looks fine. Yeah, that's fine. What? What am I doing? Yeah, yeah.
Portfolio.
The other one. I just used that. And then did you pick the, was the return to risk ratio?
There's
And
MAHs on
then did
this
you
one.
replicate that in the
What?
passive?
There's MAH01380.
See impact test it?
It's in his laptop.
I did it for, not for this one.
Yeah, go back and just put those allocations in. The other one.
this-
So you can test it, see how. Are you sure all the labels and everything like that? It's just, it's a simple one. But you, that's all you're gonna do is put on C2. Equal. And go to the closing sheet. What are you checking out?
Alright guys, I'm Rob, this is Jacob, this is Eleanor, and we're going to be presenting our derivative trade and mixed cap diversified portfolio. So our recommendation, we recommend to launch a series of retail and institutional large cap portfolio products. We target moderate risk and moderate high returns of 12% to 15% over the total holding period. Targeted investor segments are institutional at 1.25 billion and retail clients 1.25 billion, totaling at 2.5 billion. AUM portfolio within the next 5 years. With our fee structure of 1% AUM, we expect to generate total annual gross fee revenue of 25 million. This is our presentation outline.
So this is our market sector allocation. So the passive portfolio is 49% technology, 9% utilities, and 36% financial services, and 6% real estate. And then the active is 40% technology, 19% utilities, 33% financial services, and 6.8% real estate. Our largest holdings for the active are MasterCard, First Republic Bank, VMware, Verizon, and Unitil Energy. Our target market is a 50-50 split, and our target of 2.5 billion per portfolio within the next 5 years. And the desired holding periods are 5+ years for services and 15+ for institutional. And we're targeting investors who want a long-term returns. Our structure is 2.5 billion assets under management with a 1% fee. So the fee revenue will be 25 million.
This is our passive portfolio performance. As you can see, we've been beating the S&P by quite a bit, and our beta is slightly lower for the passive. But in our active, we're also above the S&P 500, and this time our beta is much lower, and we are also expecting higher rate of returns over the holding period for the active. So our recommendation is we recommend DTC launch a series of retail institutional large cap portfolio products. We target moderate risk and moderate high returns of 12 to 15% over the total holding period. Target investor segments are institutional 1.25 billion and retail clients 2.5 billion, totaling 2.5 billion assets under management portfolio within the next 5 years. With our fee structure of 1% assets under management, we expect to generate total annual gross revenue of 25 million. This is our team. Eleanor is our global portfolio manager. Rob is our senior associate global equity analyst, and I am the senior global equity analyst.
Okay, so test question. Should the fees on the passive portfolio be higher, the same, or lower than the active? Should the passive portfolio strategy fees be higher, the same, or lower than the active?
Lower,
Okay.
since it's higher risk.
So you guys are charging the same fee for the active. You're working more and you're charging the same. You probably want to charge 150 basis points. Okay, and then what we did in the last example was that we basically said that after you, which you should be working on now, you should be working on the fundamental securities analysis and the technical analysis. So we basically said that we could bump the fee to at least over 200 basis points by adding in the fundamental and the technical securities analysis to yield enhance. Then if we take the fundamental and the technical securities analysis and take the sell recommendations or the hold or the buy recommendations and the technical trading system on the buy sells and layer in, you know, the margin and being able to go short and be able to write and buy the puts and the calls, we could charge up to 400 basis points on the AUM, because now we're really actively managing the portfolio. Okay? All right, thank you. So I guess, unfortunately, Mason has to do his by himself today because we don't know where his team is.
Gotta insert one more.
Are you ready, Mason?
Yeah, you hear me.
Okay, and then you take, print out your PowerPoint presentation so I could do some edits on it.
Like right now?
Yeah, do it in black and white. And then I'll give you some corrections too. Did you figure it out? Oh, were they? Okay, so are you,
Yeah, you could print to Garaventa now.
okay, just be careful because it was already programmed.
MH?
Okay, I'm just saying, just be careful because these spreadsheets are all put together. So they just need to make sure that whatever happened to your spreadsheets, you gotta kind of know what happened instead of going back and starting to reprogram stuff. So the question is, what, did somebody else have access to that file and delete a column? And then add a column? Who is your portfolio manager? Who is in charge of your file?
Like, I was working on that.
Okay, so who owns the worksheet? Who owns the file? Okay, so you were in charge of it. Did anybody work on it other than yourself? Okay, so you were the only one. Okay.
It's probably easier for you guys to just start over and just copy paste everything again.
Well, if you already got the data, it's pretty easy.
Yeah.
You know, and then just, and if you have 5 years of data for all your stocks, it's just copying and pasting the data.
Yeah.
And then you
That's
just
what
run
I'm
the correlation, run the covariance, plug in the returns, and then run the what, 15, 17 optimizations.
If you already have all the data, it should only take like half an hour to start a new one.
Well, they already have the data.
Yeah, that's what I'm saying.
They don't even have to download it.
Yeah. But they just download the fresh worksheet, the optimization worksheet.
Well, they just gotta pull it up and just copy the data. I mean, you're done. So, however you wanna do it.
Because we messed up on ours, we had to do that.
Okay, did you guys put up your problems? Are you ready to go? Mason's only gonna take like 5 minutes.
Yeah.
Anybody else
Yeah.
wanna go today?
Yeah, if there's another group that needs to go, I need to make one more.
No, because I don't think anybody else is going.
Okay.
Because Kimberly's going later. Neil's not ready, and Matt's still, he needs to back test his stuff. And then he's gotta put the presentation and the memo together. And then print out the worksheets. And then give me the deliverable. What you guys should be working on now is the fundamental securities analysis and the technical analysis. To get that done. Okay. So why don't we do the, Mason, you need more time, don't you?
A little bit, yeah.
Okay. So why don't we go ahead and do the problems? Did everybody put their problems up? Okay. So why don't we go ahead and do that? Okay, we're going to go this way.
This is chapter 14, question 11.
Could you speak up and pay attention, please?
A 20-year maturity bond with par value of 1,000 makes semi-annual coupon payments at a coupon rate of 8%. Find the bond equivalent and effective annual yield to maturity of the bond. If the bond price is A, $950, B, $1,000, C, $1,050.
Alright, so just using a financial calculator is the easiest way to do this. So the bond price is $950, that is your PV, so you enter negative $950 as your PV. This is a semi-annual yield, so you'll just cut that in half, that's 4%. So your PMT is going to be 40, your N is going to be 40, and then the par value is going to be 1,000. So your FV is going to be 1,000. So plug all that in, solve for the yield of maturity. And so our equivalent yield is 4.26, and then we multiply that by 2 since it's semi-annual. So then our annual yield is 8.25%. And then for the effective yield, put in this 4.26. So 1.426 squared minus 1, which is 8.7% for the $950. For the $1,000, we don't even have to do most of this because it's selling at par, so we know it's going to be a 4% semi-annual yield. So then the equivalent yield is going to be 8% annually, and then the effective yield is going to be 8.16% when you just plug in this 4% into the equation. And then for the last part, you keep all the inputs up here the same, except you just change the bond price from the $950 to the $1,050. So you just change your PV, and then entering all that in, we get 3.67 times 2 for the annual yield, which is 7.52 for the equivalent yield, and then for your effective, plug that into the equation, we get 7.66%.
So I had chapter 17, problems 4, 5, and 6.
Were you guys sharing that
Yeah,
problem? Try to do one each.
So chapter 17, 4, 5, and 6, I only wrote down the questions because if I wrote down the solutions, I would be writing all of the class. Number 4 asks the differences between bottom-up and top-down approaches to security valuation, and what are the advantages to the top-down approach. Top-down approach to security valuation begins with an analysis of global and domestic economy. Analysts who follow a top-down approach then narrow their attention to an industry or sector likely perform well given the expected performance of the broader economy. Finally, the analysis focuses on specific companies within an industry or sector that has been identified as likely to perform well. A bottom-up approach typically emphasizes fundamental analysis of individual company stocks and is largely based on the belief that undervalued stocks will perform well regardless of the prospects for the industry or the broader economy. The major advantage of the top-down approach is that it provides a structured approach to incorporating the impact of economic and financial variables at every level into the analysis of a company stock. And for example, one would expect that prospects for a particular industry are highly dependent on broader economic variables. Similarly, the performance of an individual company stock is likely to be greatly affected by prospects for the industry in which the company operates. Number 5 asks what characteristics will give firms the greatest sensitivity to business cycles. And firms with greater sensitivity to business cycles are in industries that produce durable consumer goods or capital goods. Consumers of durable goods like automobiles and major appliances are more likely to purchase these products during an economic expansion, but can postpone purchases during a recession. Business purchases of capital goods, such as purchases of manufacturing equipment by firms that produce their own products, decline during a recession because demand for firms' end products declines during a recession. Number 6 is speculating that the Fed will loosen monetary policy. The recommendations for gold is that gold is traditionally viewed as a hedge against inflation. Expansionary monetary policy may lead to increased inflation and thus could enhance the value of gold mining stocks. And if the Fed will loosen the monetary policy, my recommendation on construction is that expansionary monetary policy will lead to lower interest rates, which ought to stimulate household demand. This construction industry should benefit from the loosening monetary policy.
So, mine was just a question you could just plug in your calculator. So, we find that yield to maturity on the semi-annual basis is 4.26. So, if you want to find out how I got these answers, it says just a financial calculator, enter the following data. So, your future value is 1,000, present value is -900. GMT is 40, so you find that yield to maturity on a semi-annual basis is 4.26, which makes the bond equivalent yield to maturity 8.52, which is this times 2. It means the effective annual yield to maturity is 8.7%, and we get that by using this formula, which is 1.0426 squared minus 1. And then the bond is selling at par. The yield to maturity on a semi-annual basis is the same as the semi-annual coupon rate, 4%. The bond equivalent yield to maturity is 8%. Again, that. Effective annual yield to maturity 1.04 to squared minus 1, 8.16%. Keeping other inputs unchanged, but setting the present value to -1,050 instead of -900. We find a bond equivalent yield to maturity of 7.52%. So that's annually, or 3.76% semi-annually, and the effective yield to maturity is 7.66%.
That's even quicker.
Yeah, what are you?
Tyler, are you with Neil?
So
Are you
this
in
is
this
chapter
group?
14,
You need to work
bond
with
price
them.
and yields.
He's like reprogramming the
15
thing.
is midday through the semi-annual period. Therefore, the invoice price will be higher than the ask price, than the stated ask price by an amount equal to 1/2 of the semi-annual coupon. The ask price is 101.25% of par. So the invoice price is $1,012.50 plus 1/2 of $50, which gives you $1,037.50.
I got chapter 12, problem sets 1 and 4. The first question is about technical analysis. Explain how some of the behavioral biases discussed in the chapter might contribute to the success of technical trading rules. Technical analysis can generally be viewed as a search for trends or patterns in market prices. Technical analysts tend to view these trends as momentum or gradual adjustments to correct prices, or alternatively reversals of trends. A number of behavioral biases discussed in the chapter might contribute to such trends and patterns. For example, a conservatism bias might contribute to a trend in prices as investors gradually take new information into account, resulting in gradual adjustment of prices towards their fundamental values. Another example derives from the concept of representativeness, which leads investors to inappropriately conclude on the basis of a small sample of data that a pattern has been established that will continue well into the future. When investors subsequently become aware of the fact that prices have overreacted, corrections reverse the initial erroneous trend. Number 4 is about behavioral biases as well. Even if behavioral biases do not affect equilibrium asset prices, why might it still be important for investors to be aware of them? There are 2 reasons why behavioral biases might not affect equilibrium asset prices. First, Behavioral biases might contribute to the success of technical trading rules as prices gradually adjust towards their intrinsic values. And second, the actions of arbitrageurs might move security prices towards their intrinsic values. It might be important for investors to be aware of these biases because either of these scenarios might create the potential for excess profits even if behavioral biases do not affect equilibrium prices. In addition, an investor should be aware of his personal behavioral biases, even if those biases do not affect equilibrium prices, to help avoid some of the information processing errors, for example, overconfidence or representativeness.
You can't get anything out of these people, can you? It was a great presentation.
17. Chapter 17, number 26. Coming to the stage.
Alright, so, this is number 27, chapter 17. So basically, the question says that a company called OceanGate sells external hard drives for $200, which is the price per product. $200 each. Total fixed costs are $30 million. And its variable cost per unit is $140, and the corporate tax rate is 30%. The question says, if the economy is strong, the firm will sell 2 million hard drives here, but in a recession, it will only sell half as many, so 1 million hard drives. So question A says, what will be the percentage decline in sales if the economy enters a recession? So here we have A, so sales strong, $200 times 2 million equals 400 million, and the sales for recession is $200 times 1 million is 200 million. So basically what you do is you just take the 200 million minus the 400 million, divided by the 400 million, and the percent sales decline is negative 50%. Same thing for B. This one's talking about profits. What would be the percentage decline in profits if the economy enters a recession? So to calculate profits, use this equation. P is price per unit, Q is quantity of units sold, VC is variable cost, FC is fixed cost, and T is the tax rate. You plug in all the numbers, and so you come out with the profits in a strong economy is 63 million, and the profits in a recession is 21 million. So again, you pretty much just take those numbers, so the 63 million minus the 21 million, divide that by 63 million, and you get a negative 66.67% decline in profits in a recession.
I had chapter 17, number 26. So this question was basically asking, for part A, you had to use the degree of operating leverage to find the degree of operating leverage for two firms. So the equation for this is 1 plus the fixed cost divided by the profits. So these numbers, the fixed cost and the profits, were given to you. All you have to do is plug in the 1 plus 7 million divided by the 4 million, and A Tech gets 2.75. For Z Tech, it was 1 plus 5 million over 4 million, and it was 2.25. And then part B was asking which firm was more likely to have a higher profit if the economy strengthens. And since the A Tech firm had a higher degree of leverage, you would choose that one because firms with higher fixed costs are said to have higher operating leverage, degrees of operating leverage, and because of the small loans and business conditions that they could have large impacts on profitability.
So I had chapter 17, number 17. And the question is, your business plan for your proposed target firm envisions first revenues of $120,000 and fixed costs of $30,000 and variable costs equal to 1/3 of revenue. So A is what are the expected profits based on these returns, and the equation is expected profit is equal to revenue minus fixed cost minus variable cost. So after putting all that in, that comes out to 50,000. For B, what is the degree of operating leverage based on the estimate of fixed cost and expected profits? And so the equation for that is 1 plus fixed cost over profits equals 0. So 1 plus 30,000 over 50,000 is equal to 1.6. And then C, if sales are 10% below expectation, what will be the decrease in profits? So if the sales are 108,000, the profit will fall to 42,000 right here, and that is a 16% decline. For D, show that the percentage decrease in profits equals DOL times a 10% drop in sales, and so that is just 16 is equal to DOL times 10%. For E, based on the DOL, what is the largest percentage shortfall in sales relative to original expectations that the firm can sustain before profits turn negative? And so profit must drop by more than 100% to turn negative, and so for it to fall 100%, you do 100% over the DOL, so that's 100% over 1.6, which is what we got in B, which equals to 62.5%. And then F, what are the break-even sales at this point? So that means if the revenue is 45,000, profit will be 0 after plugging into the equation.
Slide chapter 13, number 3. That one's asking what the effect of an incorrectly specified market proxy would have on the beta of the portfolio. And so likely, what would happen is the beta of the portfolio would get underestimated relative to the beta calculated for the market, for the true market portfolio. And that's often because the Dow Jones average and other market proxies are likely have less diversification, and therefore they have higher variance returns than the true market portfolio, which typically has more diversification that's according to the capital asset pricing model. So consequently, the beta computed using an overstated variance would be understated, and that's shown by the formula. It's just really simple, just algebra. That if the numerator is higher, or the denominator is higher, then it's going to be lower.
I have CFA number 1. It's just asking for a few questions about beta. Number 1 is betas are estimated with respect to market indexes that are proxies for the true market portfolio, and those are inherently unobservable. And then the second part is asking for the CAPM and not the cap, but like the relation. And empirical tests of the CAPM show that the average returns are not related to beta in the manner predicted by the theory. The empirical SMO is flattered in the theoretical.
Okay, you ready, Mason?
Yeah.
Thank you. Still need some time.
Oh, yeah, I just need to figure out. I think if I email it to myself, I can get it on to your computer. I don't have a.
Yeah, just
plugin
email
thing,
it to
so-
me.
Yeah, okay.
Click here does not have HTML.
Anybody interested in a job at the FDIC? Federal Deposit Insurance Corporation. People work for them, 3-4 years, easy salary, you get paid really well. You examine the banks, just you can go over to the Fed, you can go to the comptroller, you can go to Wall Street, become a equity analyst in financial institutions. You can go work for a bank if you wanted to. It's a good place to start. You go to the SEC if you wanted to, go to Treasury in DC if you wanted to do that. Just a great opportunity. Okay, can you talk to Mary Beth for me?
Yeah,
She's trying to place somebody there.
Was that the job or the internship?
I think it's an intern.
I think they're only looking for juniors.
Oh, are they?
I think so.
Okay.
I
Okay. I think you can handle this presentation. I don't think you're gonna be stumped. And then how do you, it's not a PowerPoint,
just did it as a PDF.
did you? Okay, that's fine. I'll just download it to the desktop. We can just do it from here. How's that?
I can send it to you as it was a Google Drive.
No, that's okay, you can just walk through it.
Okay. All right, so I'm Mason. Teammates aren't here today. Don't worry, Leroy and Pilar. So I'm gonna go ahead and present our mid and large cap casinos, entertainment, and hotels portfolio. So kick it off with a recommendation. We recommend that DTC launch a new series of both retail and institutional large cap growth portfolio products. We target moderate to high returns on our portfolio of 10 to 13%, moderate to high risk. Our targeted investor segments are institutional retail clients, with a 50-50 split for $1 billion total AUM within 5 years. Desired holding periods are 5+ years for retail clients, 15+ years for institutional investors, and our fee will be 1% of AUM for the passive and active, 2% of AUM for the target, leading to a gross fee revenue of $20 million annually. So just a quick outline of our presentation here. Going to give a brief overview of our portfolio, talk about the composition, our top 5 companies for both the active and passive portfolios, our target market. We'll talk about the active passive portfolio performance and conclude again with our recommendation. So here we have our portfolio composition, breakdown of casinos and gaming, hotels, resorts, and entertainment. Casinos and gaming is 14%, hotels, resorts is 22%, entertainment is 64%. More on the portfolio composition, market cap allocation, mid-cap stocks 50%, large cap stocks 50%, and our market sector exposure, casinos and gaming 25%, hotels 35%, entertainment 40%. So our top 5 companies based on highest weights. Over on the left, you see that was for the passive. Disney at 15, Netflix 15, Sony 14, Las Vegas Sands Corporation 12%, Marriott International 10%. We ran the active portfolio. Vail Mountain Resorts was 36%, Six Flags was 20%, MGM Growth Properties was 13%, Redline Hotels was 8%, and Marriott International was 5%. Moving on to our target market, institutional investors we're looking at, so pension funds, endowments, family offices, large high net worth individuals, that's $10 million to $50 million salaries, accredited and qualified investors. The target number of clientele are 2,000 clients in the retail segment and 2,000 clients in our institutional segment. Fees will be 1% of the AUM, totaling $20 million annually. Moving on to our passive portfolio performance. As you can see, we're up top there. We beat the S&P 500 pretty regularly with our passive portfolio. Down to the active portfolio performance when we ran the optimal portfolio based on the optimization. This is what we came out with. So in our back tests, we beat these S&P pretty significantly. For our front test, our first 2 front tests didn't beat the S&P, but our front test number 3 was slightly over the S&P 500 there. So our efficient frontier and our capital allocation line, this is what we came out with. Over here we have, this was our optimal portfolio, again with the weights we've already talked about, and this was our capital allocation line versus the efficient frontier. And finally with our recommendation, we recommend DTC launch a new series of both retail and institutional large cap growth portfolio products, moderate to high returns of 10 to 13%, 50-50 split for $1 billion total AUM within 5 years for each of our 3 planned portfolio products. Desired holding periods of 5+ years for retail clients, 15+ for institutional, and our fee will be 1% of AUM for passive and active and 2% of AUM for the targeted, leading to a gross fee revenue of $20 million annually. I'm Mason, I'm the technical securities analyst. Lee's our portfolio manager, and Nicole is our fundamental securities analyst.
Good job. So on Friday, what I'm going to do is I'm going to show you how to take your active and your passive portfolios and you're gonna set minimum maximum constraints on your stocks. You're gonna take the two approaches and reconcile them as a first pass target. And then you need to start working on the fundamental securities analysis and the technical analysis, particularly the fundamental, because that's going to give you an indication of what stocks are trading, or you come up with intrinsic values that are premiums to the current stock price, and you're going to want to overweight to those. And there may be some technical analysis where you think some of the stocks may be on a really strong trend or could be breaking out to the upside, and you're probably going to want to overweight them a little bit too, using the technical analysis. Okay, so I'll walk you through that on Friday. And who's going to present on Friday?
We are. Chapter 18.
Okay, so is just the team leads. Okay, so what do we have, 3? 1, 2, 3, and then you guys in the back, so 3. Okay, good. All right. And then who's doing the chapter presentation? Okay.
That's what we meant.
Chapter 17 was gonna go.
Okay, I was talking about the portfolio.
Sorry.
So let's do the portfolio first. How many people are doing the portfolio performance? Okay, 3, 4, 5. Okay, just the team leads, just the portfolio manager. 1, 2, 3, 4. And then the chapter presentations? Okay, perfect. I just wanted to know how much time we have.
Professor, did you want like the Fisher Frontier on the slides?
That'd be cool to see.
Okay.
And I did like the way he presented the actual allocations. You can even show that what you want to do is have a slide that has the target in the middle, passive on the left, and active on the right.
Okay.
And we don't have to do that yet. You
Yeah.
just show the allocations.
Okay.
All right. So this is the presentation I'm doing in about 2 hours.
It's a chapter 17.
Remember
Team number 8.
in the pre-test, or on the quiz, in 123, when we laid out the market allocations over time, the 70-30, the 60-40, 60-30-10, when they added in real estate in the 80s, then they added in real estate was there in the 80s, 10%, and insurance got the 10%, and you were always taking from the bonds. And then the target long-term model portfolio was 10% real estate, 10% insurance, 10% alternative renewable energy. This is the new asset class. Okay, this is the new asset class. Okay, cryptocurrencies is another. I can do a presentation on that later. But alternative renewable energy, particularly under the California mandates, to basically get 100% of their energy from renewable energy within the next 10, 20 years is a very aggressive objective. And we've already met our minimum requirements already, where we're sourcing at least 30% of all of our energy is being generated through alternative renewable assets. And the renewable assets, the alternative assets could be biogas, geothermal, wind, solar, and then the other is community choice aggregation. But the community choice aggregation is just the utility that's set up to aggregate the renewable energy to meet the mandates at the state level. Okay? And I'll talk about that a little bit later. So first what we did was, it was a bunch of real estate professionals that we worked with, and then some energy experts in wind, geothermal, biogas. We brought in some traders who could actually trade an energy desk. The company I worked for actually built one of the first trading desks to actually source energy from the grid in different parts of the country, and then to run logistics over the grid to figure out how to deliver the power to the power plants or to the data centers when they needed it to run the production runs. So we actually went out and found the energy, put in the bids on the energy, got the energy contracts, figured out the distribution of the energy from the source across the grid, which you need a logistics engineer to figure that out, to then to be able to deliver the energy to the plant or the data center on the day at the time, at the price that they had contracted. Okay? So what I find fascinating about the energy space is it's just like real estate. It's another capital market. It's an emerging market. And what we've done, which maybe we talk about later, is we've actually married the renewable energy asset class with the cryptocurrency asset class to create a platform for investment for institutional investors. So I don't know how cutting edge you can get, but it's pretty cutting edge. So our company has the principals have over 2 years agglomerated experience in capital markets, in real estate, or in energy. And here's basically the solution. So we're basically the hub of the spoke. So we work with the public utilities, the equipment vendors, because we have to buy the power generating equipment. It could be geothermal. We work with GE and Siemens to basically get the power generators either running off natural gas, wind, geothermal, equipment financing, working with banks and other financing agencies to work with the utilities or these renewable energy developers to be able to get them the financing they need for the equipment. The actual developers, these are just like real estate developers. A lot of these developers are from Texas because they've done oil and gas extraction in the south and maybe the northeast or the Midwest. And these developers will go out, they'll find land, they'll find the resource, they'll see if there's an ability to interconnect and build that asset that will generate that energy. And if there's a connection to the power grid, they can hook it up and they can distribute the energy across the grid. Also consulting, the ISOs, these are the regulators that basically regulate the power markets by geographic region. And then you have off-takers and others that are doing other stuff. So we're kind of in between as the consultant. And here was basically our business model. Was these are the steps to basically going from finding the site through the entitlement process all the way to actually delivering the energy. So first, we have the land rush phase right here. Land agreements, resource assessment, environmental review. Then you have the bottlenecks. This was where we were targeting right here as our value add in the consulting process. Because this is where the developers fall down. Is they usually call us up, they run it through this phase and they get to this point and they go, we need an interconnection study. It's like, okay, great, where's your project, where's it located, blah, blah, blah. Oh, that's gonna cost you $150,000 for an interconnection study. And they go, oh, shit, I had no idea. I didn't even think about it, that we were gonna have to spend that much. So basically what we do is we do the economic modeling, we do the interconnection study, we help them through the entitlements and the permitting, and then the sales through the power purchase agreements. The PPAs are the actual contracts that we negotiate with PG&E and SunPower, and, Edison in LA. I mean, we will negotiate the power purchase agreements on behalf of the developers. And then you have the consultants that come in here, permitting, sales, financing, technology, management. We've got low-risk developers in here, adding the management. And then you have small utilities, trading, asset management, regulation, repowering. We can repower these assets too once they've gone through their economic life. Acquisition and dispositions that we can negotiate and work on their behalf to dispose of assets and maybe even help them figure out how to repower and recapitalize it and then sell it to another utility. Funds from operations and capital, other things. We can bring in investors, and we can provide basically a value-add consulting service in market making, and maybe even some investment banking, M&A, if that's what they want, all throughout the whole process. And actually my partners right now are working in these areas, and they're actually making a lot of money consulting these companies throughout these processes. So here are some of the programs that we identified that we wanted to go after. Power and Water Resource Pooling Authority, San Francisco Public Utilities Commission, Marin County, they actually launched their own community choice aggregation. Kings River Conservation District, Port of Oakland, Sonoma County. These were basically all the resources that they basically had available, and this is the amount of generating capacity that we could bring to the marketplace, or that they were in control of. So these were basically the services, new generation asset development, generation asset optimization, physical asset management services, load serving programs, and energy opportunity funds that we could bring into the process. And then here were the services that we identified that we could bring to these 6 utilities, and what value we could bring to the process. And then here were the utilities that we had identified and our strategic partners. Reef Guggenheim were basically the infrastructure private equity firm that had already built private equity funds to invest in these types of assets. So these guys were really big in real estate, and they migrated into alternative renewable energy assets. GE was going to provide us with the power equipment to be able to generate the power from the steam and the natural gas. And then these were basically our partners, the utilities. They're usually smaller utilities.
Is this company producing its own electricity?
No, we were just
You're just like,
these are the ones that are producing the electricity. Here, what we're doing is we're going in and consulting them to help streamline their generation, and we're helping them aggregate renewable energy and help them identify renewable energy assets to put into their portfolios. So we don't generate anything, we're just the intermediary in the marketplace. Here's an example of basically how it all works. So this is us right here. Legal, regulatory, consulting, strategic planning, management controls, risk management down here. Here are the customers. Here's the metering and all of the data. So a lot of data processing. This is basically the schematics. You got to have a large amount of accounting, treasury, load planning, supply planning, system simulations. It's all quant based. We've even developed some of our own proprietary software to be able to run and distribute energy across the grid using the optimization procedures that you just ran through, the mathematics behind it. We basically said, and I basically told these guys, listen, why don't we do the quadratic optimization using the grid to basically source and distribute the power using the same quadratic optimization procedures. So they figured it out. They hired a software company and a consulting company, used the Markowitz optimization procedures to optimize the power distribution and sourcing across the grid using exactly the same procedures. So everything that we're doing is we're applying the corporate finance theory and the economics, not the stocks and bonds, but we're doing it in the energy market. And it's a totally different market. And here are the principles involved in the process. So Sam's an energy partner. He has over 17 years in energy. He's got another 10 years in real estate and capital markets. Manu Pulia, he's the CFO of the company. He was the CFO of a wind utility in the Dakotas for years. Jesus, he's up in Sacramento. He does all the regulatory and legal around the state, because the state basically regulates the energy markets. Kent Palmerton, he's the portfolio manager. He has multiple years experience in actually bringing assets to marketplace, developing renewable energy assets. Don Stupin, he's our engineer that does all the grid optimizations. Ronald Suss, he's the chief technical officer. on the IT side. Matt Garling, he does business development and works between the utilities, the capital markets, and the vendors. I'm the chief economist that built out the indexes and the portfolio optimization procedures. Jim Rice, he does the engineering. Trevor does business development and capital markets and energy trading off of our energy trading desk. And then we have other partners, such as UC Berkeley, Lawrence Livermore, and other partners that be able to get this stuff done. Any questions so far?
I think one of your partners was San Diego State.
No, San Diego Utility.
Okay.
But we can work, did you see San Diego State?
I thought it said San Diego State, so.
Yeah, we can
It says
work
City
with
of San Diego, State of California.
Yeah, but we actually did approach the University of Anchorage, Alaska, to be able to go up there and utilize their physical footprint on the university, to be able to build some renewable energy assets, either fuel cells or other types of assets on their campus, to be able to meet their generation needs by using all renewable energies. And we've also worked on some other things through the state of Alaska. Also, they're very interested in what we're doing on the renewable energy side.
That clock's slow.
Is it?
Yeah.
So here's the piece that I put together for these guys. And this all totally makes sense. This should make sense for you guys, because you're doing exactly the same stuff. So I basically developed an indexed approach, which you did, a dynamic approach, which you did, analysis process flow, active versus passive management, potential late-stage equity investment, and then how do you actually select the assets. So this is basically you have the weighting schemes, the scoring system that you saw in the dissertation for real estate, exact same thing for the equity assets. If you add the alternative renewable assets to your stock bond portfolio or to your capital market portfolio, it actually shifts the efficient frontier out. It actually reduces the risk and increases the return. Because these renewable assets are the contracts, the power contracts, basically lock in the revenues, and the revenues basically are increased at stepped rates tied to the inflation rate. So it's very similar to real estate.
That clock is broken.
Is it?
Yeah, 12:53.
So this is basically what I did was we figured out the value. We took the power times the generation capacity, and figure out basically the aggregate value for each of the types of energy across the different ICOs. Okay? These are basically the regulatory authorities by region. And what we could do is we could create a passive portfolio optimization strategy to be able to sell to the institutional investors. Yes.
Class in 5 minutes ago.
It did.
Yeah.
Awesome.
That's what we keep trying to say.
Oh, sorry. I thought you'd be throwing things.